Welcome back. Well, what a volatile year it has for the markets. Now we are looking ahead to the new year. What can we expect out of 2019 after the last 2 months of the year had wild swings? I spoke with one of the country's leading money managers, John Kodunis. He is CEO of Calamos Investments, and here's what he said about investing in the year ahead.
We're going to continue to see this volatility with the administration and what's going on in the world and the market with the Fed, geopolitical. Volatility is going to be here. So I think that's going to be the constant that we're going to see going forward. In terms of rates, the 10-year, I think we're going to trade in this range. I don't think we expect any huge surprises. Anywhere between where we are now to maybe as high as 3.5%, but not much higher than that. I think the curve's going to continue to maybe to steepen a little bit more, and so the shorter part of the curve is going to come down a little bit in yields. In terms of equities, I think that people are going to have to, I still believe in the growth story, but it's going to be a lot more tactical. I think we might see a shift in allocation from some of the more crowded tech space, like the FANGs, into some of the less crowded tech sectors. And financials, I think, will start to do even better here as rates start to creep up a little bit. Now, I don't see rates creeping up because of inflation, but just naturally creeping up.
Right, because they were at zero for so long. Look, we had, 4 interest rate hikes in 2018. We're expecting there should be at least 3 in 2019. What has been the impact of higher rates on your business?
Well, first, I'm not in the camp that it's set in terms of how many rates are going to be.
So maybe you think maybe
forward.
It's not going to be 3.
I think that the Fed has to have a script. And when they go off script, we see market moves up or down. And we're anticipating what they're going to do. I think going forward, the Fed's going to be very accommodative. I think nobody wins if they choke the economy. So if the economy continues to be extremely robust, we might get those 3 moves. I think the economy is going to continue to do better, but not as robust to actually need those 3 moves.
Yeah.
And as they continue to take down liquidity and supply also, that counts as a move up in rates as well. So I think it's a balance they have to do. I'd be surprised if they do more than just one more rate hike for 2019.
Yeah, all right. Well, certainly we've seen the market not really sure how to react to higher rates, because when you've got 10% in the 3-year, you can say, okay, well, maybe, I'm sorry, 10% in the 2-year. You might say to yourself, well, maybe I will shift some money out of equities and into fixed income.
Sure.
What kind of shifting are you seeing in terms of your clients? How are your portfolio managers dealing with higher rates in one area of the market and perhaps the idea that I could get that with some safety, let me shift money out of equities?
Well, I think the last 2 years have been extremely interesting because of the volatility in the markets. And the seat that I sit in is really an interesting seat because we see a lot of retail flow. And what does mom and pop bring into, and what are they looking for?
Right.
So they're looking for downward protection. They're looking for preservation of capital. And so some of our funds are market neutral, our Phineas Long Short, our hedge equity funds, those have seen a tremendous amount of increase in assets under management because it solves for some of the issues that our customers are looking for. And that's protection on the downside.
How does the backdrop look to you? I know there's all this worry about slowdown coming. How does the backdrop look on the global economy at this point?
Well, there's no question we're end of cycle. What does that mean? End of cycle in the past means, okay, stop, pencils down. That's not the case. This is a different type of cycle. Rates have never been this low. And end of cycle can mean 2 years, can mean 3 years. And our investment professionals and our downward protection in terms of risk management will continue to do really well in this end of cycle environment. And we feel it's going to last a lot longer than it has in the past. So that's what we have to look at. Yes, we're end of cycle, but the cycle can take a lot longer than it has in the past. And so you have to be defensive. A lot of our strategies are increasing the hedges by more, maybe 10% next year than we have in the past, because this end of cycle, we feel, is going to last a lot longer. And so we don't want to leave a lot of upside on the table, but we want to protect ourselves.